So I am Eleanor Mills. I'm the founder of Noon. Thanks for joining us today. And we have with us the amazing Helena Morrissey. Yes, Morrissey. It's an old friend of mine and great support of Noon ever since I first set it off on our advisory board. And Helena and I have known each other for really quite a long time now. It's
Probably too further long ago than we would either of us guess
we
to
would
remember,
care to
but it's
admit,
definitely been many, many years, Eleanor.
probably like 15 years, maybe more. And I remember interviewing Helena when she first set up the 30% Club, and I used to write about her a lot when I was a journalist, and we've done lots of different events together. But I always love doing things with Helena because I think that her real passion for making women more savvy about their money and the importance of has shone through everything that she's done for, for decades. So she really walks the walk on this as well as talks the talk. And what we're going to be trying to do today, what we've been doing with these great AJ Bell sessions over the summer, is really kind of trying to open up for you a forum, a kind of safe space to ask the questions that you've always kind of wanted to know the answers to, but you have kind of felt like you would sound like a bit of an idiot if you asked. So there are no stupid questions in this.
No,
Really no stupid questions, and it's a really good opportunity. Helena is, not only the esteemed Baroness, but also has been an investment manager for
I
30
was,
years.
I was, I was a fund manager to actually running like 15 years, but obviously then running a fund management company for another 15. So yes,
Yeah.
these days I chair an endowment fund. So I'm very much involved in the markets day to day as well these days.
Yeah. So she really does know her stuff. But one of the great things about the whole AJ Bell Money Matters project, of which Helena is also the chair, is really trying to democratize and feminize, I think, the way that we think about money and explaining to women that this isn't something scary, kind of euphemistic, crammed with anachronisms that we don't understand, which is how it's usually presented. But this is something that we can actually all get our heads around. And I think it's really important because actually the power of the Queen Age of Pound is massive. And if we all start to kind of flex it, we can really exercise our power in the world. And it's part of raising our voices and very much part of I think, the Noon project of kind of empowering women at this point, because we're also going to live, if we're lucky, a lot longer than well, our parents, and also particularly women live longer than men. And yet we often retire with 35% less in our pensions than men do. So it's actually really important that we start getting our head around our money because, as one of the ladies in one of the pieces that we ran for AJ Bell said, a man is not a financial plan, and there are no kind of white knights kind of riding in on a charger to kind of rescue us. So we've really got to get grip on this. And so I'm kind of waffling on a bit so that everybody can join. I can see there's still people joining. But basically, this session is going to be all about investing our hard-earned money, what that kind of means, what we might put it into, why that's a good idea. And I know that a lot of you were really struck by Danny Hewson's talk when she showed us the graph about why it's a terrible idea to keep your cash in cash, why we think that, cash is a kind of safe option, but she just gets nibbled away and you're not really making anything. That really took away. So let's I'm sure we'll all come out of here with some similar great bits of insight from Helena. So why don't you kind of kick us off in a bit about your passion for this whole project?
Hmm. Well, as you've said, thank you, Eleanor, and it's great to be here. And obviously, I'm very happy to be part of your Noon setup, which I think is making real waves for midlife women. So thank you for inviting me on. So I guess, it's no secret that I've been very passionate about gender equality for many years. And you mentioned the 30% Club, which is around trying to get more women on boards. And it was literally 15 years ago that started. So, Eleanor, you have dated our relationship correctly by mentioning the 15 years. But of course, money is a big part of power, and financial independence is obviously a big part of just creating sort of having control over our own destiny in all other respects. And actually, I came across something that Beyonce had said, which was, she genuinely said, money gives men the power to run things, and pointed out that obviously that's ridiculous. We shouldn't be delegating such a big thing to men. So I've come over the years, and it has been quite a lot of years I've been involved in trying to create, as you beautifully put it, sort of more democratization and feminization of money matters. um, that actually, if we don't resolve financial inequality, then it's going to be an uphill struggle to resolve gender inequality. So I think that finances and sort of domestic situation where we also sometimes have the lion's share of the domestic chores, those are two big sort of precursors to real gender equality. So, and we are making strides, I think. I think during lockdown, there was some evidence that women, I was one of them actually. You might think that women who work in finance would be right on top of everything, but I sorted out my pension during lockdown. I'd sort of put that off and sort of identified where everything was and gathered it all together. But up until that point, I think a lot of women, we're just really busy day to day. And it is something we don't prioritize enough for ourselves. We put our children first, we put our family. Oh, you're on mute because we've got some background noise from Ramona.
Yeah.
And I think it's really, we need to sort of shift around our priorities. And I'm not saying it's the most scintillating topic for a lot of people, but if you can stop worrying about money so much, and if you can feel more relaxed about it and feel a more sense of security, well, I think that's worth investing a bit of time in as well.
And I always love the way, I remember you saying to me years ago that financial fitness was any other kind of fitness, which was that you needed to do it little and often.
Yeah, I mean, I think it's very daunting. You think, okay, so where do I start? Particularly if you're not familiar with some of the lingo you mentioned, it's not all about jargon. Well, sadly, it is. A lot of the literature is full of acronyms and, words that people haven't heard of. It's another sort of language. But yes, this idea of getting into good habits about it. And I think that's been made a bit easier by technology as well, because obviously nowadays it's a lot easier to go on websites and look up things. It's a lot easier actually to subscribe to apps where every time you buy a coffee at a coffee shop, 40 pence, that rounds up your £3.60 coffee to £4. It's amazing how much coffee costs these days. Goes into some sort of savings pot. There's a lot of different tools and tricks that we can use to make it more fun and less daunting, I think. But don't try to do it all at once. I mean, like me, pensions one day, should I pay off expensive debt another? They kind of take it one step at a time.
So what would be your kind of first your kind of first advice? So here you are, you're a woman in midlife. I think most of the women on here have got, most, I think lots of us are kind of professional, have got some jobs, will have a bit of pension, might have some savings, might still be kind of paying off a mortgage. I mean, what are the kind of first rules of one's kind of personal finances? What are we looking for? What does good look like?
All right. So first I have to do a little disclaimer that I can't offer financial advice because technically that means sort of something that's very bespoke to people. So I'm going to be giving guidance, just putting
Sorry, guidance, not advice.
So a kind of checklist. I would start with the checklist. And first and foremost, it is really to kind of get your arms around, if that's not sort of muddling metaphors, your sources of money, your sources of income, your pension, any investments that you might have perhaps made over the years, or perhaps, inherited something, your savings. So do a bit of a financial mapping of everything that you have, and also then the things that you have as outgoings. So it sounds a bit like budgeting, but I'm thinking more of longer term. So ultimately, and this might sound a little bit like a big thing to do, but you could sort of map out the next sort of 10, 20 years, big things coming up, like I have to pay off the mortgage at a certain point. Need to save up some money for schools, for university fees, that sort of thing. But the first was get your bearings. So don't sort of rush into, I must buy this product or this service. First of all, just do a little bit of an MOT on your finances. What is the current picture? And some of that might include how long you want to work for or intend to work for. It might turn out to be different from wanting. It worked out that I can retire at precisely the age of like 93.
Yeah.
Large family and outsized commitments, but you can at least get your head around that. And I think that gives you also a sense of real sense of control over it to start with, that you're not, and this is where I sorted out my pension in lockdown, because I was sort of lying awake literally during that very stressful time on money levels and thinking, I'm 55 and I work in finance and I advise on pension. Not proper advice, but I have a role in pension, and I don't know where all mine are, because I've never given myself the time to sit down and map it all out. It didn't take very long. But once you do that, it's very liberating. Or it might expose a problem, but once, you can't solve a problem until you've identified it properly. So the starting point is to analyze, that's probably a bit of a big grand word as well. Just sort of map out the ins and outs on your finances and get to grips with them.
Okay. So having kind of
Yeah.
kind of worked it out. So it's also, I mean, in some ways that can be I think quite an exciting exercise because
Mm.
you kind of say to yourself, and I think women are really quite bad about doing this, as you say, that we kind of respond to the everyday all the time, rather than she having a more strategic look. So I was doing this with my husband the other day, and it kind of encouraged us to have a conversation about what the next kind of, 20, 30 years, if we're lucky, 50 years might look like. Our kids have just gone off to university. And so we're really kind of thinking, well, do we need to stay in the house that we're in? What do we actually want to do? We've got kind of accrued, I don't know, some money in the house and some other kind of pensions or whatever. How best can we start to harness that money that we've got for the life that we want? So I think it doesn't have to be a boring conversation about the kind of numbers. It's
No.
also a conversation around what would you actually like this to look like? That I found that quite interesting.
Exactly. And I think once you start, you're talking about having a conversation with your husband, people may not be married or may have gone through a divorce. I think having a conversation with someone, not necessarily an expert, but just articulating as well as a sort of next step. Once you've mapped it out, I mean, that conversation, Eleanor, might have led you thinking, actually, we'll put the house on the market in a couple of years. You might have put a date on that. Now, we
Mm,
did that a few years back, and then the market collapsed, the housing market collapsed in London. Sort of overnight, interest rates started rising the next day, sort of thing, and it was clearly not going to be a great time to sell.
mm,
So my little spreadsheet then had to be adjusted. So as long as you can adapt, and as long as you're not sort of fixated, but it really helps you, as you say, you kind of move it from being a dry, always don't really want to talk about money, it's going to be boring, to actually realize, actually, you know what, if we downsized, we could invest and then have a better retirement. If people are still
or we
going.
don't have to kind of work so hard. I mean,
Well,
that's
that's,
that's
perhaps
one
the
of the
goal.
things, isn't it? It's all kind of to say, I was just
Mm.
thinking, well, it might give us choices that we currently, don't have, and I think one can get quite tricked into thinking it has to go on being the way that it's been. But actually, I think what some of those kind of more long-term conversations can open up is a real question about, well, what would you like it to be? And that doesn't have to be a kind of couples conversation. You're totally right. About 40% of the community, and are not with a partner, and also about 30% of them don't have children. So this is not
Mm.
necessarily, and once
Uh,
family comes in lots of
Yes.
forms, it can be your kind of friends or who it is you're thinking
Yeah.
where you're going to be. But I think that actually beginning to open up that longer term conversation, particularly at this point at kind of, 50, 60, um, when we've done quite a lot of the kind of hard, the heavy lifting, as it were, of that 25 to kind of 50, 60 kind of stage. I do think there are some bigger questions about what would we like this to be, and
Exactly.
that's quite an interesting jumping off point.
Yeah. So I'd make 2 points. One is you used the word choices, and I think there is this danger of feeling when you get to a certain age. And obviously, we've sort of skipped over the reality that a lot of women end up with a lot less money than men do of the same age. It's a sad reality. You mentioned the good news is that we might be living longer, but obviously you want to live well. And if the reality is that most women have earned less than men during their life of work, because of the gender pay gap, because of taking career breaks, there's a lot of sort of financial wobbles, the AJFL language is for it, that where we might lose out with respect to men. So if we just kind of blindly go on and sort of hope it'll work out in the end, unfortunately, any shortfall that we might have is going to sort of magnify as we get older. And what we're trying to avoid, and I really don't want to have a sort of downbeat tone to this discussion, because we will end up with, what can we do about it?
Mm,
But there is a danger that obviously a lot of women, many more than men, face the risk of financial hardship. And many more women are dependent. I think it's something like 2/3 of women, not sure what age, but I think it's over 70, are totally dependent on the state pension. And it's roughly half that number of
two
people.
two
So
thirds of women are dependent
I
on the
think
state
that's the number. Yes, I was just checking it ahead of our call, but I'm pretty sure that's the number. And it might be 60%, slightly less. But that is difficult to live on. So what we're trying to do at this stage, when it's not too late, I want to emphasize to people, even if you think, yikes, I haven't done this, getting financially fit. I haven't invested. I haven't sort of worked out where all my pension sits or if I even have enough. It's not, it's better late than never.
Mm.
Let's get to grips with it. First of all, work out what the shortfall might be, and then start sort of doing something about it. And it's never too late to start investing. It might be too late to start investing in very risky assets that might sort of go down very much if we need the money in 5 years or 10 years, because that's probably the shortest time for investing. But it's still, let's say, better to get started now than never get started at all.
So,
And
so,
don't feel
so
that you're trapped. Try to
yeah.
get that mindset. I'm trapped. I have to work forever. I'm never going to have independence. I'm going to be poor in my old age. We've got to try to empower ourselves and do something about it.
So what? So how should we begin to think about investing? So
Mm.
Danny very clearly said to us all last time, do not just keep your stuff in cash because it gets nibbled away by inflation, and you're it's just not a sensible place to put it. So say you've got kind of, I know, some ISAs or that you saved over the years, or some savings, or you've inherited some money. What's the first thing that we should be thinking about in terms of those investments?
So, well, there's a few first things. One is to invest sort of tax efficiently. So there are, I'm sure everybody on the call hopefully has heard of ISAs, individual savings accounts, and these allow you to invest up to £20,000 a year tax free. So when it grows and you get income from it, you're not being taxed. So obviously £20,000 is a lot of money. And you might either not have that or think, well, how can I even start if I have a much smaller amount? Perhaps, I mean, Asia Bell, sorry to do the advert, but you could invest monthly basis, only £25 a month. That's the minimum. So you can just start small. I
Mm.
have this mantra, think big, start small, start now. You might not be thinking big about financials, but get going. So open an account. It doesn't have to be obviously with AJ Bell, lots, but check on the fees. And then do something if you're not familiar with investing. And obviously there are lots of resources out there. We've got a website. Hargreaves got a website. There's the government's money helper websites. There's a lot of different resources. If you just kind of Google, how do I get started on selling investing? You can easily go down a big rabbit hole but just, it's like as if you're buying a car. You do not have to know how an engine works to buy a car. You just have to know how to drive the car and sort of how to pay for it. So in this case, what you want to do is make sure you're not paying too much on the fees. And a lot of people, when they get started, just buy a fund that's a collection of lots of different investments. And they would usually have them on any of these websites or apps risk rated. So if you are an older person, midlife person onwards, you won't want to buy something that's extremely high risk unless it really is play money that you don't mind if you don't see back again for a while. You would tend to be sort of more cautious or a sort of balanced type of approach. But don't think you have to know everything about every investment to make the right decision. It's better to invest in something than not at all. So I recently had a conversation, appreciates the other end of their working lives, with two of my children, one who's in her mid-20s and one who's just about to leave his teens. And they both wanted to get starting on investing. And so they opened an app and the Asia Bell account through the app. And then they basically just put in £25 a month. And one just wanted to invest very cautiously in UK equities, and the other one to invest entirely in US technology stocks, I think, or something. I don't know if you actually could do that on Asia Bell, but anyway, he found a way to do that. And so some of it's to do with, your natural, what you're interested in. And then
Yeah.
once you dip a toe in, this is why it's important to start. Once you dip a toe in, it's quite fun. You check, and if it's not enough money to get really worried about, if it's £25, £50, £100, you can start getting the idea of what's going on in the world that changes the price of the investment.
Mm.
And then it becomes something you gradually get into. So please don't think this is all about the end of the webinar. Rush over account, put all your life savings in, pick a fund from the vast range out there. Just go slow, take it one step at a time. And it's just like, I don't know, that gym session. We can't run a marathon. You probably do run marathons. I don't know. But anyway, you
I
can't run a
certainly
marathon
don't.
the first time you set up. You have to run 1 kilometer, 2 kilometers, build it up. And then you get comfortable with it. And you suddenly think, I get what they mean about that. And again, Asia Bell does podcasts. We have articles. When data comes out, like the latest economic growth numbers, there's a bit of a sort of, this is what it means. And you can just sort of treat it as a bit of a hobby, maybe, and set aside, I don't know, half an hour a week just for keeping up your hobby.
Yeah, so you can actually kind of actively go in and kind of, fiddle around with them and see what's happening
Mm.
to them, can you?
Yeah, yeah,
So
you can just log on. You've got your portfolio there. It might be just one fund, and um, that's what gets you started. And then you might get more adventurous or think, actually, I'd like, I've got a view or something. But most people who are successful investors actually just delegate the actual running of the money. You're not having to make those decisions day to day if you pick a fund. And of course, I must use the word diversify. Very important, not just to rush into one company stock that you just read about in the newspaper that day. You can buy single stocks, but of course, then you could lose all your money because that company might go bust. So the whole point of a fund is it's a lot of little bits of company. And you get the benefit of being able to buy that because your money, your £25 or whatever it is amalgamated with everybody else's.
and so what kinds of returns, might you expect? So say you put £10,000 into a kind of UK equities kind of, fund. What might you expect to happen to it? I mean, if you'd done it like a year ago, kind of what would have, or
Of
5 years
course, not every year the market goes up. I have to say past performance is no guarantee of future performance.
future?
But
Yeah,
what you'd be looking to do as a minimum is to healthily beat inflation and interest rates. Because
okay.
obviously your alternative to investing, and this is what I'm sure, I'm afraid I was away for her webinar, but when Danny spoke, I'm sure she emphasized this and you mentioned it briefly,
Mm,
that what you don't want to do is end up with, the sum that you put in the bank actually being able to buy less than when you started out, which is what happens if the interest rate is not keeping up with inflation,
yeah,
as we've seen over the past year. Now, of course, we had a very big, so bless you, and we've had a very sharp sort of fall in inflation lately, but we've still got relatively, higher interest rates have only just started to come down. So your alternative might be, you might get 4% in the bank. You've got to earn more than that. And historically, you've been able to make 8 or even 10% each year from investing in the stock market. And of course, that doesn't sound like, whoa, wow, that's amazing. Got 4 more pounds for every 100. But of course, over time, if you leave it in, the compounding effect is the key. So if you'll give me a moment, I'll work it out on my calculator if you want to work out with the
yeah,
£10,000 compounded. But it's important, or £1,000 comment, it's important to leave the money in if you can. So ideally, what you do, and I've seen people do this, again, if you're more of a spender than a saver kind of mentality, siphon that money off before it actually gets to your bank account. You can have a direct debit go into the account that you've set up. You never see it. And then you just keep an eye on it from time to time. Don't watch it every 5 minutes. I'm saying watch it initially because then you get a hang of the idea. But investing is a long-term business. And so ideally, you're not checking it every 5 minutes because there'll be those awful headlines. Sorry, because you used to be very proficient and wonderful journalist, but there'll be this headline sort of billions wiped off stock market. Don't panic is the usual
yeah,
answer. No, the time in the market is much more important than timing the market. So over time, and again, these are sort of
okay,
general principles. That's why I buy stocks gradually as well, because you might think, oh, we've just had a little bit of a setback. I'm going to put money in now. And then there's some major catastrophe. Or on the other hand, you might think, oh, market's gone up, must chase the next, bit. And that's the peak of it. So just if you have a disciplined thing every month, a little bit of money goes in, money that you haven't spent yet, you haven't noticed you've not got. And then you check that at the end of the year after you've got a habit of investing. And you might think, wow, this is really nice. I'm gonna double my investment each month and just keep an eye on it. And hopefully you start to enjoy it.
yeah. And so if you so say you're putting in your you're doing your calculations, but if but
Sorry. She really wants me to do the
I
calculation.
really want I because I it's the real world. It was kind of really seeing the kind of Danny's graph of how much less money you'd have if you just thought you were playing safe and put it in the bank into the cash ISA. And so and and because of the kind of new technology and the apps and things, we don't necessarily need
Got
to.
the answer now, by the way.
Okay, very good.
So if you had £100 and you invested and got an 8% return every year and did that for 10 years and you left it alone, you would have £216 basically at the end. I'm now going to give you the sum if you just left it in the bank, just so you can see. I mean, obviously, this is not going to change your lifestyle necessarily, but you can see how the money has more than doubled, even though it seems like quite a modest return. over that time. If you were learning 4% in the bank, and that's probably quite generous for today's world, but anyway, you would have £148. So, you can sort of see what, and then leave it another few years, and perhaps you've also put £1,000 in, not 100. And you can see how this can really make a difference. You actually got another sort of 30% money
Yeah. On top of
on
it.
top. Yeah.
And so if you're thinking of doing that, I
Mm,
mean, what exactly? So when you say you're buying a kind of UK equities fund,
yeah.
kind of what does that mean? What do you actually buy? What does it do?
So you're basically buying a share of all. So this is what's called a tracker fund I'm talking about here. So you get a low fee on that, and you buy into a fund that allows that basically gives you exposure to all of let's call it the all share. So all of the listed UK companies, most diversified type of fund that we're talking about. And again, I don't want to sort of show you my own account, whatever. But on your phone, you can download an app like the Dawdle app, which is the most simple one. My sister is a very clever woman, not meaning that she can't have money, but she said, help me. I don't know anything about these money things. I said, just download the Dawdle app and see how you get on. And actually, she called me the other day. She says, oh, I'm really enjoying the Dawdle app. I've invested and it's going well. And she'd had a poor experience as another competitor that we shall not name. And it's just very simple. You basically, and I did this with my daughter, Millie, there's a list that you can invest in and you can look up what each one is. You do have to do a little bit of work. I mean, you can't just sort of say someone completely take it away from me.
No, but
But
this is
it's very
this is
simple.
what we're trying to
Explain to buy a pair of shoes
yeah,
sometimes,
a lot longer.
I think sometimes, yeah. But
But I think what we're trying to do here is to kind of, demystify it. I think it's
yeah.
good to think that you can do it kind of, with small amount of money to begin with and just kind of see what happens. And also that these new kind of apps and things make that much easier, that you don't need to be kind of ringing your stock or whatever it is that, people in bowler hats used to do.
So, and then the annual charge, because I've said it doesn't cost all that much, and it's similar for some of the other competitors. So again, I'm just with AGBL, so I have to cite them.
Yes.
It's 25 basis points for the annual charge. So then there's this ongoing
what does
charge
that
that
mean?
adds it up, and our growth funds have the charge of 31 basis points. So that's 0.31% for the whole lot. So it really, even if you add it, for the difference of that 4% or that 8%, or it might be 3.5 and 10,
Yeah.
you're not losing that from the charges. Some people don't look at the fees, and then they don't realize that being charged like 2% or 1% or something. That really obviously would completely undermine the whole point of doing this. But your point, Eleanor, I just need to just mention that yesterday, it sounds a very odd thing to be saying, but I was speaking in an event in Kuwait on women and prosperity. And we had a session on women and investing. And this is all about economic empowerment of women. And the questions being asked were the same. Like, oh, we find money, it's very complicated. That's the challenge. And of course, again, the woman who was doing the presentation, they were saying it's not complicated. It's just daunting when you don't know anything about it, when you don't know how to get started. Once
Yes.
it breaks through, it's like anything. And I say it's just like, I'm sorry to keep banging on about this, but it's just like going to that gym the first time. You're like, oh, I'm going to be the only person who doesn't know what to do, don't know how to use the machines. Everyone's going to be looking at me. This is even easier because you just do it on your little phone here these days. You don't have to even have a phone call with someone. And obviously, if you have a lot of money, you might need to seek advice, proper advice, and have a financial advisor. And again, you can look that up about the best way to get one of those. And I'm not going to, AGBO doesn't offer any advice. That's not one of the things we do. But obviously, we work with a lot of advisors, and there's lots of good ones that would help you if you've got a lot of money. Make sure you're tax efficient. Make sure you're, doing the right things. So yeah, just don't be scared of it, because that just means that we're ostrich if we're scared. We just put it off, and then it's worse.
It's a good question here from Jen, which is something I was worried
Okay.
about. She says, do I need to get rid of my debt, credit card rather than mortgage, before I invest? It
Yeah.
seems like investing is the way to build wealth, but my impulse is to
Yes.
pay down debt first.
Yes. First step, sorry, I should really go through this. So do your mapping out. But if you have got expensive credit card debt, the first thing is to pay that off, because you're very unlikely on an ongoing, consistent basis. Sometimes the market soars, the stock market soars, but you're very likely to make the same returns as those very high interest rates. So in the sequencing, then pay off the debt first and then start with your little, however, this is probably not official advice or guidance, but there's nothing to stop. If you're talking about a very small sum of money, while you're paying off that, if you can just, put your 25 in there to get that, your bearings, then once you paid off your debt, you'll be all ready to go. So I think you should still be doing your homework about investing. And hopefully that would also give you the excitement about it, or start to build some excitement, because obviously we know debt's a bit addictive and people pay it off and then think, yay, I've got a blank credit card statement, I'm going to go spending again. And obviously what you want to do at that point is be thinking, actually, I'd rather buy some stocks, because then I might be able to spend more money later on.
Yeah, or have some awesome stability or some.
Yeah, we're just not
And
worried.
and
Yeah.
is that true of of kind of a mortgage as well? I mean, if you have some spare money, is it better to pay off the mortgage debt to kind of, particularly at the moment with interest rates being quite high, to kind of lower one's monthly outgoings, or better to start building up more of a kind of nest egg?
So that was one of those $64,500 questions, because obviously everybody's, or seems like it when I talk to people, their mortgage is different. They fixed it for a certain time. You don't want to pay a penalty if you pay a piece off.
Mm.
And some people fix theirs with a lower rate than we have now. So you want to keep that as long as you can. Others, you might have, as you know, what seems like a very high interest rate now. And therefore it is it's kind of a bit six of one, half dozen other. Obviously, what you do know is the interest rate on your mortgage, unless it's a variable rate, but you don't know the returns from the stock market. So if it's like six of one, half dozen the other, yes, pay off the mortgage first. If there's a charge attached to paying off the mortgage, well, just keep steadily paying that off. If you've got a little bit of spare cash, start investing it.
Okay, rather than say
Yeah.
overpaying the mortgage or
Yeah. Well, if you're going to
debt
be
penalty.
penalized for it, like, there are obviously sometimes quite significant costs for early repayment of a fixed rate mortgage. So, but everybody's circumstance will be different. You kind of need to do the calculations, but never
Yeah.
assume. My rule of thumb would be never assume more than like 8% from a standard sort of stock market investment. You might well make more, but for the purposes of planning, and you'll have some years where it's a loss too. There's obviously some years over time, if we believe in economic growth and if we believe in capitalism as the model, you're going to make a higher return than other investments, or other than just leaving money in the bank. But obviously that isn't the case every quarter or every year.
Yeah. No. Okay. No, we're getting that. And Jenny here is saying, what about ethical investing?
Mm.
She's saying, here we go. It's a good question, Sam. What about ethical investing? At the moment, it would seem wise to invest in all the companies that are, say, bringing to market the extreme weight loss medicines, Ozempic, Wegovy, that kind of thing. But she said, I wouldn't want to invest in any of those stocks. Would I find a similar return on investment with ethical funds? I mean, for instance, I took a lot of my money out of kind of, oil and out and into kind of,
Yeah.
put quite a lot of stuff into kind of green energy. Wasn't
Well,
really actually in terms of making a return, but it made me feel better.
there's an argument raging, particularly in the States, about, that it's either profits or purpose. And certainly, obviously, in 2022, when Russia invaded Ukraine, defense stocks and oil stocks both went through the roof.
Yeah.
And ethical funds, or responsible investing, or ESG, environmental, social, and governance funds, tend to lose out relative to bad funds, if you want to call it like that, less ethical.
Yes.
But over time, I think that companies that are managed for, in a responsible way, and you can argue what that is, but perhaps funds that have good employment practices, that don't use, obviously child labor or anything like that. Funds that make sure that women, underrepresented groups in their firms, are well looked after, and firms that invest that are in ways, or build their business in ways that are good for the environment, etc. It's not just like to think, but I believe that they will win out in the end, often as not. So I don't think it should be profit or purpose. But obviously there are times, and I mentioned one of them, when sort of ethical funds will underperform less ethical funds, and vice versa. When tobacco suddenly goes crazy because somebody has done some deal with Philip Morris, something like that. So I do think that women, I've done quite a lot of research on this, we women like to invest in funds that are aligned with our principles. And
Yeah.
I think you can make good money by doing that. You just have to be careful when you buy something that claims to be responsible. Just look carefully at it, because I mean that they're mentioning there about a particular drug. I'm now not aware of any fund that excludes the makers of Ozempic at present. So you might don't be fooled by the label. Sometimes the label looks like, oh, it's going to be a very pure fund.
Mm.
So look and see what it's actually investing in and whether
Yes.
that aligns with interests
Yeah.
and values. But I genuinely think that I'm a believer in good triumphing over evil kind of person. So and I would prefer myself to be investing, and wouldn't mind giving up a little bit of return if I wasn't, you know, doing something that was harmful to a group in society or to the
Yeah,
environment.
and I think that there's a bigger point here too, isn't there? Actually, as female investors, we can choose to put our money into, say, funding female entrepreneurs or
Yeah,
green projects, rather
yeah,
than kind of oil. And actually, those decisions have a big consequence.
yeah.
I was sort of particularly if you're concerned about the environment, that actually taking your pension out of kind of oil stocks or those kind of things, is one of the biggest contributions we can make as individuals.
Definitely. And actually, I mean, I think that's a good point, because I don't want to imply that the only way to get investing is through the listed stock market. That's one relatively straightforward route these days. You mentioned, supporting female entrepreneurs. You can join a network if you have a few £1,000s to invest, and you want to also, perhaps you might be someone who might be able to mentor someone who's just starting a business. They're called angel investors, and it's not like you need billions or millions even to do this. And there's an angel investment network, which I can look up quickly if I get the precise name. Um, but it's a really great. It's actually called Angel Investment Network. There you go. So that's it. Um, and you can. There's got I'm looking to fundraise or invest, and then investment opportunities through that. And basically, you can get involved. So if you want to get involved with small businesses, and it's obviously like a consortium, so you can sort of, and I know people who do this quite as their job, they angel invest as their job, and they get stuck into particular enterprises, and they help mentor the founder, and then you can choose, yeah, I want to invest in female founded businesses. But obviously that's a very different thing than if you're just kind of doing it as a financial, here's my small amount each month, let me get invested in the stock market. And of course you
Yeah.
can do both. But it's an interesting thing, because at the moment, obviously, we are seeing a wave of interest and enthusiasm and pickup in the number of female founded businesses, which is very welcome. Globally, female founded businesses only get 2% of the monies that go to all the businesses that are being started up. And part of that is because there aren't enough female investors at the firms, the private equity and the venture capital firms investment. But we can put that right a bit by getting involved in this relatively small way, en masse, if we so choose.
And if you've got a SIP, say, so
Yeah,
that's a
self-invested.
self-invested pension.
Yeah.
Um, Within that, you can designate particular kinds of funds or investments you want people to make, can't you?
Yes. Now I'm looking up a bit here, because I'm not a complete expert on the range that you can do, but there's definitely a range of um there's an FAQs I'm looking up here. So these are so the point of these, as the name suggests, is that these are for people who are happy to make their own investment decisions first and foremost. So when I talked before about delegating it to a fund manager, you can have funds um within the self-administered, self-invested pension plan. Um, but you can basically, it's a similar, well, similarly, but you've got much more flexibility over the types of investments that you get
Yeah.
from a normal
So there you really can kind of pick and choose what you want them to do.
Yeah. So it's not like your company pension plan where they're making all the decisions. This one
No,
is
then you can.
you deciding it. Yeah. So this would
Um,
be, yeah, a way. I'm not 100% sure, actually. I did read something about it once, but whether you can delegate a portion to angel investments. Someone on the call might know that answer to that.
I don't know,
Um,
but I know that within the kind of SIP, if you're my SIP is on a big platform called Trans,
Okay.
And
Yeah.
within plans, you can select, to a fund which supports, say, female founders, or something which only invests in kind of green technologies, or those kind of things. So
Yeah.
few options. And Wendy is asking, I have a SIP, which is a managed fund. If
Yeah.
you want to invest, should I just put more into, or do other investing to support it? Great question, Wendy.
Yeah.
I know the answer to. So if you've got a kind of SIP, should be the focus of your investing.
Mm.
Should you also then have a dollar app where you're playing around with the stock market?
So, obviously keep changing the rules on things like lifetime allowances and how much, you can withdraw potentially tax free. They're talking about potentially
Yeah,
changing that.
that's
Really,
really cracking
yes,
down on
that
that.
could be, a
Yeah,
whole sort of curveball thrown into
yeah,
it. But at present, really sort of maxing out, as it were, your pension is a very tax efficient way to save and invest. And obviously, if the fund is being managed, then as long as you're happy with the performance of it, and they should be sending you statements and you should be able to track how it's doing, then it does make sense to keep building that up. But there's nothing to stop you, particularly if you have a particular interest. And I hope this is coming across loud and clear today in our discussion, that investing isn't just about, making money, although obviously that's a very important motivation. But if you have a particular area of interest and that you would like to sort of, put your money to work in, and we've talked about ethical investing, we've talked about supporting women, then sure, you want to do it and have a good return on it, but there's no reason to not to diversify and to have some money that you dedicate to that. So I'd like
yeah,
to think money. I've talked to somebody who runs a wealth management firm the other day, and we were sort of not arguing, we were talking about cryptocurrencies and whether that makes sense for people if you don't have sort of play money. And she said, well, what they just suggest is that if there's just a tiny piece for their clients, it doesn't have to be like the major part of the portfolio, but actually it's quite a good idea to try and have a bit of a balancing act between different things. And then if there's some massive run in crypto, then you're not missing out on that. And try and think of investing. I know it's a very serious matter, and we started off as talking about, doom and gloom issues of women being poor in their old age. But also if you do have enough to try a few things, you might want to experiment a little bit and find your métier, your niche.
yeah. And, and,
But
and also something, something like crypto, or those kind of things which are very much at the kind of beginning of their lifespan. you- we might suddenly do. I mean, there are some theories out there which say will end up being the basis of all the kind of
mm,
money in the world. I mean, actually, it's going to have a huge environmental impact, isn't it? Because the energy involved,
uses a lot of
yeah,
electricity.
it involves
Yeah.
a lot of energy. But anyway, but it may end up being the kind of thing that actually underpins the whole of the banking system. So therefore, not to have anything
Yeah.
might not be the wisest in the long run. So you're saying that kind of spread your bets.
But also things that, and this is how I approach money with my children, things that ignite your interest. You're much
Mm.
more likely to stick at something and to develop if not a passion, then a real interest in it. If it's something that initially you think, actually, that's really quite interesting. So I used to look after bonds. I was a bond fund manager. And the joke always was for everybody else saying bonds are boring, because it was basically you could never make much money from them. You just tried not to lose any, and you've got this interest rate on them that would be higher than what you could make in the bank. Now, actually, for me, they weren't boring because actually, if you manage them very actively, um, you could make quite a lot of money from it. And you could also, if a balanced pension fund, like many people will have on this call, they will all have some money in bonds. So you might as well have every part of your portfolio, doing well for you. But you've got to have something that you really, ideally you have something that you're interested in rather than you're like, oh, because like finding I couldn't lift weights. Someone said you're going to be keeping fit by lifting weights. Well, that would last about 30 seconds. It's, but doing Pilates, that's my thing. So find your thing when it comes to investing and you'll, hopefully then whatever age you are, it'll be a bit of fun. And you could do it for a grandchild or, a child as well. You might, set up a children's ISA. You might do something a bit different than not just saving for yourself.
Yeah, no, I think that's a good way to think about it. That it can be something that almost like if we're going to be kind of well-rounded kind of citizens of the world, we should have kind of a few stakes in this and kind of kind of understand what's going on. So Linda says, how does investing in real estate compare? Because of course, lots of people on this call have got property as part
Yeah.
of their pension. So how does investing in real estate compare with investing in funds/shares, etc., in terms of risk? bricks and mortar have traditionally been a more secure option if you've got the
Yeah.
money for the initial investment, etc. What do you think?
So this country obviously has, we're a nation of people who've been obsessed about home ownership and so forth. And historically, it definitely has been a way to make decent returns. I would be hesitant about investing in property, just because I don't know enough about sort of, if you were starting to think I'll buy to let and that kind of thing. That all seems quite fraught to me. And everything I read suggests that there's a lot of tax breaks that be
Yeah, that
clamped down on
doesn't
that.
look like the thing at the moment, does
That's
it? With
a
the
bit
no.
more sort of speculative. I think for me, I think again goes back to this balancing act. You can't really spend the money in your property until you sell it. Obviously, there are obviously ways to raise equity, sometimes slightly controversially, or raise money from the equity that you have in the house. So I think you need to again look at it. I hate the word pot really because it seems like a very odd kind of word, but I have my liquid pot of things that I could sell if I need the money. My long-term investments, which are going to grow hopefully in line with whether it's the economy and then my house, which is first and foremost a home, but you would expect to have some sort of return. It's definitely part of my own portfolio.
Yeah.
Obviously, having a large number of children, we've needed a reasonably large house to house them in. And so, like you, Ellen, I'm thinking, well, we wouldn't need a house this size forever and a day. I can't sell it yet because where would they sleep for now? But, and it's too expensive to rent. But it's definitely when I do my sort of, pie chart of what I got, it's a big chunk.
Yeah.
I think that's the case for a lot of people, and I think that's fine. Just don't rely on it for day-to-day spending, obviously, because that's just not going to happen.
Yeah, and I think that there's also something in there about kind of realizing that if most of your kind of assets is in your house, which certainly if you've lived in the Southeast, probably is. I mean, I would
Mm.
say, most of them, majority of the money that I have is in my house. But you're right that you can't, 'cause even once you paid off the mortgage, you're still not going to be able to access the equity in your house without selling it. That was the thing that I
No,
suddenly realized the other day. It's like, well, even if I stay here till I paid off the mortgage, and then I'm still not then going to be able to use any of
mm.
this to live in a different way. So I think that's quite interesting.
And as I say, there are these equity release schemes, and I think I've heard both good
Mm.
things and horror stories about it because sometimes the terms are such that you're sort of signing over,
Yeah.
a lot to that you would be otherwise leaving to your children or other inheritors, or just kind of ending up with a bad financial deal. So you do have to be careful and read the small print. But I have also heard of people who've been very happy with it. It's helped them, stay in their home when they wanted to, and then obviously it gives them some cash. But the reality is that at this stage, you kind of want to look at all options on the table. Going back to the original premise, get your bearings of you know
Yeah.
aspects of your liabilities, what you want to do and what's realistic, and then try to make, the income bits bigger than the outgoings.
Yes, the Mr. McCormick.
But
And another good question about and quite a lot of the women in our network are freelance. So what about when you're freelance and you need a good chunk of money in cash for feast or famine times? I've been thinking that too because I've got some money in the bank and I was thinking, should I just like pay off a chunk of the mortgage so that I don't have to work, earn so much every month? But then at the same time, that's the kind of emergency fund. So if somebody, gets
mm,
ill, or whatever, what's the kind of rule on that? So she says, "What feel like she did a good chunk of money in cash for feast or famine times. I keep mine in a cash ISA. I'm wondering again if there are better ways to keep money I can get if I need, but what works better if I don't need it? Because
mm,
to what you're saying about the return and it losing money and
yeah,
20 grand or something, which is your like rainy day fund. So you've got some money to keep
yeah.
you going on the months that you might not have any work. What's the best thing to do with?
Yeah, so I can be very clear-cut about this. Do not invest in the stock market on money that you might need within the next sort of 6 to 12 months. Really, that's I know it's frustrating because actually I have a number of roles and a couple or several of them pay me quarterly, and they all pay the same blooming quarter. When I feel as rich as Croesus that minute money comes into my account, I think stop. I've got to now. I pay all my bills that I haven't paid.
Yes.
Put aside that money for the university tuition fees, put aside that money for next term school fees. So it kind of all whistles out the door straight away. But even if I had some left over, I know that the reality, if you invest, then, and especially if you did it a lump sum because you have this big sort of money sitting in the banks, clearly that could go down quickly. And there's also the transaction costs, that you trade on the once. I don't want to get into like complicated things, but it's you have to factor in that you probably pay a little bit going in and out of a fund as well. So just do look
Yeah,
on,
so if
investing
it's
really should be a 3-year plus. And a lot of people say 5 years. And instead, just make sure it's earning a decent rate of interest on the bank deposit.
okay, so yeah, so move it around.
That. Yeah, shop around for that because there is quite a lot of difference. Obviously, don't, there's also, again, and this is why people don't do anything, I know, because they read the horror stories and they think, oh, that's going to happen to me. You're protected up to £85,000 by the financial compensation scheme if your bank should go under. But if you go for a really high interest rate, there's usually some catch to it. There's usually sometimes a bit of a dodgy institution or something's wrong. So, having
Or it's got a restriction on
or it's got a
how
restriction where
easily
you
you can
could
get the money
withdraw
out.
it. Yeah.
Mm.
So read again the small print. I'm not trying to scare anybody. There are some good high street bank offers that you can just shop around and get a decent, just don't leave it with your bank if they are paying one of the lowest rates, and just make sure you can access the money when you'll need to, or make a
So
note of the dates you're going to have to give
I
them.
discovered I had a bank account, which even though it said it was a kind of savings account, wasn't paying me any interest at all. So
Hope you moved the money.
I've moved the money and shut the account. But it's amazing how often,
Yeah.
you don't realize it was actually one of my daughters. It was my daughter's boyfriend. He was talking to her about putting some money that she'd had from her child trust fund into, a savings account, which paid more interest. I suddenly realized I was getting absolutely zero.
Yeah. No, and I must admit, again, for teaching my children about money and reminding myself when I showed them, this is what you earn on interest this past month, by just having some money in savings. So that's a start, gives people this sense of money growing. But yeah, I'm afraid it really is not a good idea to sort of, dash in and out of the stock market, because you've got an extra 10,000 or 20,000 that month that you might need in 3 months' time or 6.
I know that's
Not going to work. Yeah.
yeah. So that's
This should be little. And again, what you could do is, and what I try to do and sometimes fail, is you put that budget together, and then you might work out you've actually got some money that you won't need to access for the next couple of years, because actually, times have been good recently. You've got some extras. That's a good. The excess is the good moment to then say, actually, I'm going to invest that before I spend it on something I don't really need.
Yeah, I think that's really wise. So don't necessarily think just because your bank account is in the positive that you should just bung all of that balance into an
No.
investment if you're then going to need it. And I think for lots of us, particularly if we've got kids and university kind of things to pay for, or or school fees, or just any of the kind of ups and downs of life, it's worth having a kind of to keep some kind of a cushion.
And I know you said that 30% of your members don't have children, but for the others, I think this is the next dilemma as well, as how do you balance? Because obviously these days children don't tend to like flee the nest and be gone forever. I think that's a nice thing in lots of ways, but we've got two of my daughters now live back at home after their university degree, and they both work in London. There's no way they could afford the rent. Certainly they couldn't afford the rent and food, so, I mean, while they're single, they want to, live at home and save their money for hopefully being able to put a deposit down or rent somewhere later. So again, these costs and, it has to be factored in for longer, I think, for midlife people now, that often we're talking about, another phase that wasn't really expected before, when you might be catering and, for a bigger number than you'd planned. Obviously, you could charge them rent, I suppose, but that slightly defeats the purpose if you're trying to help them out.
Trying to get them to save.
A lot of people ask me, how do I look after myself and be generous to my adult children when they need, trying some help financially?
Mm.
And I just say, put your oxygen mask on first yourself, like they say in the aeroplane. Make sure you're not going to sort of go under or really struggle financially, because then you're probably going back to your children and asking for a handout from them. So, just don't be generous to a fault.
I think it's quite a difficult one, as the kind of kids coming back, because I've been having this conversation with various different friends who all have slightly different takes on it. So I've got one friend who's talking about what she calls shrinking the nest, because she lives in central London, and she's like, I don't, as long as we're living in this big kind of family house in central London, why would they ever have an incentive to kind of, to move out? And but then it's also really difficult. I think you're right that it's beginning to kind of it really has an impact. And lots of people thought, okay, when the
Mm,
kids have left home, maybe we'll sell up and we'll move, somewhere else, or or downsize. And actually, they're not really being able to do that because they're still
mm.
um having to house their kids. So your position is house them and get them to save up.
Well, I think because that ultimately will help them be independent, and hopefully they'll be a little bit more established in their careers and everything. It's suddenly when I was, when I was 21, I was shipped overseas. So I'm like, I think my parents, I don't think they would have. My parents, lovely, had a lovely childhood and upbringing, but I'm not sure. I think they thought the job was done when I was, graduated, and that then it was off up to me. So maybe we've just changed. I think it's a mix of circumstances that actually is genuinely harder for young people to find
Yeah.
their financial footing. And perhaps we've allowed people as well, we've kind of, I don't want to use the word cosseted, but we've allowed them longer to become real adults, as it were. And I mean, I certainly love having my two daughters back at home. And I know it won't be for that long, I suspect. It won't be, it's just more like I think it's a
Hiatus.
window. Yes, a
Yeah.
little window. And it's, reminds me slightly of lockdown days. So everybody was sort of put together suddenly all over again. But I think it's a highlights that things are quite unpredictable. So we've talked a lot about planning and getting your bearings and taking things, one step at a time, understanding investing. But ultimately, I think the other thing to bear in mind is, of course, that, one can lose a job, you can have ill health, um, the circumstances of the world might change. So I think trying to get yourself in a mindset again where you're not feeling encumbered and worried about those things, but you feel financially resilient. And even if one's not, even if, there's a bit of a panic sets in, one was made redundant or a job disappears or something like that, then having that open mindset to actually that's what happens in today's world. It's much less job for life or jobs for like till
Yeah.
retirement. It's more fluid. And I know that's easier said than done, but I found myself, I went through menopause and during lockdown and was trying to change my career, and the whole lot was very overwhelming. But actually working on my mental approach to it and not being phased was a very big part of then sort of rebuilding. And now I don't feel superhuman, but I feel I could take on pretty much any challenge that life throws at me, because there's been a lot to deal with. And I know I'm not alone in that. It's been a very unsettling few years, I think, for a lot of people.
Yeah, and we talk about queenagers, as we call them, being forged in fire, just because we know that they've been through so many of these challenges, and we see that in our research that by 50 over they over half of women have been through at least 5 massive life events. But also that as a result we become happier, that the women who've been through the most actually ended up the happiest with their lives. I do think that at this point that part of the thinking about the financial planning is the beginning to ask ourselves those bigger long-term questions. What would we like the next 10, 20, 30, 40 years of our lives to look like? How are
Yeah.
we going to get to that? What does that mean in terms of our financial planning, and really looking at what's there, how much we're going to need, means we may have to in where we might go. And I think also part of that resilience is thinking, well, actually, if the worst comes to the worst, maybe I could sell my house, or this is how we would downsize, or this is how we would do it. So I think that building in some of that resilience
Mm.
to the way that we're thinking. I always think that the best way to deal with anxiety, to really kind of look the thing that you most fear kind of right in the eyes and go, okay, well,
Yeah.
what would I do if the worst happens? And so almost have a kind of different kind of scenarios kind of planning. And so I think that that's quite a good exercise now. So, best possible world, this is how it would work. If it goes wrong, or if I left my job, lost my job, what would happen? And actually having worked through those scenarios and really looked at the numbers is a good way to get rid of some anxiety, and also to accept at this point change will happen. Either we've
Yeah.
been through
Yeah.
massive change at this point, or it's coming, or our parents die, or all of those kinds of things. And there's also huge transfer of wealth from the
Mm.
great generation, our parents, to particularly women in midlife. So I think that Helena's suggestions of investing are particularly kind of pertinent for lots of us. Are kind of in we have to inherit some money, or we're thinking about how we pass that on to our kids and instill in them some of this this kind of good financial habit doesn't seem so daunting. Um,
Definitely.
I'm just having a look. Oh yes. So, oh gosh, we've got to the end of our hour. That will pass very quickly. What I would like to say to all of you is, we are having a big. We're calling it the October Queenager Jamboree. In Covent Garden.
Like, how many superlatives can you get in one?
Yeah, exactly.
One,
It's going to be
one.
fantastic. Which is partly which is being funded by AJ Bell, and we're going to have a big quiz on lots of the kind of things that we've learned over the last a few months in these sessions. But it's also going to be great fun and a chance for you all to kind of hang out, meet each other. Lots of the AJ Bell team will be there. All of us from Noon will be there. It's free. It's in Covent Garden. There will be drink and fun and booze. So, come along. 8th of October. You can sign up on Eventbrite where you signed up for this. And also really do, if you're interested in this and you've got into Helena's idea about this financial fitness little and often, I really recommend the AJ Bell Money Matters newsletter. The link's in here. And also their podcast, and even their kind of little clippy bits on Instagram, I think are really good. So I think for all of us, it's a learning journey of going, this isn't something necessarily that we've really kind of felt that we needed to get into, but a bit like, I mean, I now do a hell of a lot more fitness and like self-care at 53 than I ever did, in my younger years. And that this is part of us building up some muscle and some resilience for the long haul, and that we need to take responsibility for this ourselves because no one else is going to do it. And actually, it doesn't have to be that daunting, and there are little things that can help. And that's really what we're trying to offer you kind of here at Noon. And thanks so much to all of you for coming to all these sessions. And
great questions. Thank you.
yeah, really good questions. And I hope it's been useful. And do email us over the over the kind of coming weeks or whatever. And also, if you've got more specific questions that you'd like to ask, lots of the AJ Bell team will be at the Jamboree. So come with your questions, and I'm sure that they can help you with it. And if there are other things that you'd like to know. I hope this has been helpful in terms of kind of setting up. And as ever, huge thank you to Helena.
Pleasure. No, it was fun. The hour passed very quickly, and I'm sure we probably could both win a prize for talking a lot, but hopefully everybody took something away from that. And if nothing else, I see someone saying they had a meeting with a financial advisor and they've been dreading it, and now they're not so dreading it. So if we've achieved one thing, it's that Sue not dreading a meeting with the financial advisor. But there's nothing to dread. It is, all I want to emphasize to everybody is just if one doesn't do anything about these things, then sometimes a shortfall will get worse. And if you do something, then you could end up feeling very relaxed and happy about it all. So just take that first step.
Yeah, and I just think it really is part of kind of getting a grip on all the things that are coming at us at this point. And not being an ostrich, I think is a good mentality. Is to like actually kind of really looking in the eye and working will make you feel a lot better about what the situation is. And it can always get better.
Of course. Thank you so much.
Thank you. Big thanks to Jen for manning and for Jenny Putley, who's been doing loads of organising behind the scenes. Thank you. And big thanks to Helena, and see you soon. And hopefully see you all at the Jamboree. Come along, it'll be fun.
Thanks, Eleanor.
Up here is going to be our super host and compare. So I'm glad she's got lots of questions because we'll need those. Thanks very much, everyone.
Thank you. Bye.
See you soon.